Hello, everyone. Good afternoon. Welcome to the final bar. Today, my guest is Joe Rabil from Rabil Stock Research, joining us for the first time, giving us sort of a top-down view with some individual stock ideas, perhaps as well. S&P accelerating into the close, the Dow as well, mid caps and small caps participating finally after taking a week off, it felt like. But the NASDAQ, led by technology, also materials really leading the way higher. Breadth not confirming, but the market does not care, continues higher. Ladies and gentlemen, this is the final bar. Hello, everyone. Welcome to the final bar. I'm your host, Dave Keller, Chief Market Strategist at StockCharts.com here in Redmond, Washington. Thanks for joining us every weekday after the close for our show. Thanks for checking out all of our programming, to be honest with you, on our YouTube channel as well, including previous episodes of this show. As I mentioned in the introduction, the S&P just continues to accelerate to the upside. I'm giggling a little bit because I just had a lot of debates in the last 48 hours with friends, former colleagues, people like Grayson Rose here at StockCharts and many, many others. Tom DeMark, Ralph Vince, a number of people all sort of weighing in. Tom McClellan, Walter Deemer, all weighing in on the irrationality of the recent advance. But again, it's at the end of the day, we can debate why the market should not be accelerating. We can debate about the narrowness of leadership or the perceived narrowness of leadership, the lack of confirmation from certain breadth indicators, which we'll get into a little bit. But at the end of the day, the market continues higher. And I think if there's one thing I learned early on about technical analysis that drew me into it, was that is you're not debating what should happen or what could happen. You're focusing on what is happening. So there is no better time to be focusing on the charts and the message inherent in them. I wanted to hit some upcoming guests. I mentioned Joe Rabil joining us today for the first time. Very excited to have him on the show. Tomorrow we have Dave Landry. And on Thursday, Mark Young from WallStreetSentiment.com. Just as a heads up, Monday's the Labor Day holiday, so we'll be taking Monday off along with hopefully all of you, and we'll see you back here next Tuesday, the 8th. Also, a quick heads up on September 22nd, special event coming up called Introducing StockCharts ACP. We're having some great conversations with the management team, Chip Anderson, Grayson Rose, and others, the StockCharts TV team, to put together this presentation on our new advanced charting platform, ACP. We're just talking with Larry Williams, Ms. Schneider, Dave Landry, some of the great plugin providers that are going to give us a quick overview of how they've contributed to ACP and what it can do for your process. So check that out coming up on September 22nd here on StockCharts TV. Let's get to our market recap. And as I mentioned, the S&P continues higher. And today, for example, this is one of the more to be honest with you, one of the more traditional offense days that we've seen in a little while, because usually it's been a little less broad. It's been sort of a narrower advance led by some of the mega cap tech consumer communication names. Here was a little more of a broader move, and you see the S&P up 75 basis points. You can see the NASDAQ 100 up about double that, 1.5%. What's interesting, though, and I think the key message from looking at the updates going into the close, mid caps and small caps participating, with small caps leading the way higher. That is not the condition that we've been experiencing for quite a while. This is very, very unusual. Very quickly looking at some other markets, bond that's actually finished in the positive as well, up over 1%. That pushed 10-year yields back below 70 basis points. Gold and silver essentially flat. Gold finishing just a little above zero, and silver finishing in the negative side. Let's start at a chart of the S&P 500, and just as to review where we're at, and where we've come from. So the S&P 500 clearly in an uptrend, higher highs and higher lows. We blew through 3,400. We're now at 3,525. I remember months and months ago when the market was back around here, I remember talking with Craig Johnson, who said S&P 3,600. I'm pretty sure I either made fun of him on the air or I made fun of him before or after the show when we were chatting, thinking, dude, that's ridiculous. Or, coming out with 3,600. It's not that far from where we're at right now. And again, I lost that bet fair and square, but you have to acknowledge it. And again, well before today, that the market is in a cyclical uptrend. And I think at some point from early April to now, you probably came to that recognition. The RSI, there are a number of things that are really interesting about the market right here. The RSI overbought with an RSI of 79, and we're nearing that extreme overbought region. This is the highest the RSI has been in since last December. And again, my base case has to be a pullback here. Anything I've learned about technical analysis tells me when the market has run this far, when it's become this overbought, when there's so much upswinging in some of the key names, and any that we could throw out there, it's so overdue for a pullback, and also with the breadth being so questionable, it's showing you that that there's a pausing that's either starting to happen under the surface or is very, very close to happening. So we could be sort of in that late December period, which means you have more of an upside. That's where we start to get some divergences. It looked like we were having divergences back here in July into early August. They did not pan out. And again, divergences are the warning sign. The breakdown in price is what validates that. We never really got that validation. So I think it was continued further. And I think now that's what you're looking for. You're looking for stocks that are overbought coming out of that overbought region. Until then, the trend is higher. And again, hopefully well before now, you've recognized the uptrend. There are a lot of techniques, by the way, that are meant to project further upside. I use very little of them, to be honest with you, only because as a trend follower, I learned that when the price hits an objective, it's hard to take profits when you think that there's going to be further upside or potential for further upside. And spending time with institutional money managers, when the market hit an upside objective, there's no way you'd want to sell that because it's doing well, it's helping your performance. Why would you ever want to exit a position like that? Having said that, I've talked with some of my my peers around the industry, talking about 3550. That was a Tom DeMark level based on his absolute retracement study, which incorporates Fibonacci retracements. Also, it's the upper end of a long-term arithmetic scale chart of the S&P 500. So perhaps that is where we're at, but sort of get in that 3550 to 3600 range. That's where the measurements from this first big bull flag that we saw in May that takes us to about 3600. So we'll see where we end up relative to those points. But until proven otherwise, the path of least resistance remains higher. I did want to hit just very quickly because I know we have a lot to cover in today's show. I just wanted to hit on, when I talk about a lack of confirmation, when I talk about the week of breadth, this is the chart that's sort of in the back of my mind, one of them at least. This is the S&P with the cumulative advanced decline line. So this is the main way that I measure breadth, which is showing you for large caps, mid caps, and small caps, basically looking at daily closes, how many stocks closing up or down on the day in each of those indexes, and accumulating those values over time. What you see here is a sort of a divergence, right? With the small cap breadth clearly going lower, mid cap breadth as well, and then the large cap breadth kind of holding up in there, potentially putting in a lower high here this week, but we'll have to see how the week sort of plays out. But you can see that as you go down the cap tiers, the lines, the slope of the line is definitely increasingly negative. That, to be honest, is characteristic of bull market topping patterns, right? Where you have the market going higher, a relatively small number of large companies can continue to push the index higher when the average stock, or a lot of participants, a lot of members of the indexes, are already rolling over. And that's kind of the breadth signal that we're seeing here. It's similar kind of to the pattern that I thought we were seeing back here in June. And I remember when the market topped in June, all of a sudden you felt the big pullbacks in the small cap breadth. I thought, okay, this might be the rollover that we would expect. Did not play out. We continued higher. But at this point, as the S&P is overbought, seeing this negative divergence with breadth, with again the smaller and mid cap parts of the market struggling a little more, I think is important to pay attention to. So we'll have to see how that plays out. But I think that's when I talk about lack of conviction in the market or lack of participation. That's sort of the chart that I have in mind. And again, is if and when those break down through some support levels, now that if they've made a lower high, if they make a lower low and break below the swing low, that would be sort of the validation of a downtrend, a confirmation of a downtrend, or a signal that there's potential for further downside. I've not seen that yet. just looking very quickly at some stocks that have moved around a little bit, and different markets as well. Apple's group, computer hardware, finishing very strong. Also, home builders up almost 3% today. So I think that's important to pay attention to. Tesla crashed today, down almost 5%, and I say that very much in jest. With the run that it's had, it is well overdue for a number of days like this to come back to earth in some small way. But it's worth noting it's down pretty significantly. When I think the challenge, psychologically from a sentiment perspective, I think a lot of people sort of see the moves in Tesla, see things like ZM, which have just shot up like a rocket today based on an earnings beat. You assume that that's just going to continue in perpetuity, and of course we know that's not likely to happen. At some point, things need to come down. But ZM jumped from 320 to 450 plus. Overnight here with a huge earnings when they surprised on all sides, top line, bottom line, et cetera, up over 40% today. So, charts like this are sort of confirming that the trade that has been working leading into now continues to appear to be working. There's potential for further upside. We're even surprising on stocks that arguably should have already been priced in. We should have known how well Zoom was doing, but it's given us an upside surprise as well. In terms of things that do not look as attractive, and again, I wish we could get into to some of these a little more, but I think in terms of the red flag alert, we've been talking about biotechs for a little while. I've highlighted them recently. This is the IBB, which has been underperforming for the last 6 weeks now. A couple key members of that index: Regeneron, AbbVie, others you can see on the bottom 10 list. These are the bottom 10 stocks, or the 10 stocks in the large cap universe losing the most in their scooter scores, and Regeneron was actually number one, and it's just starting to now making a new closing low for the last couple months, right? Closing below 600 again, down over 4%. So it's still in bull market range, and the fact that the RSI remains above 40, but overall relatively weak, and that's those are charts I would certainly be keeping an eye on going forward. We need to take a quick break. Be back with my guest Joe Rabil. See you in a minute. Hello, everyone. Welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. As a reminder, we love to hear from you. Get your feedback, get your questions on technical analysis, on charts, on the markets, on particular themes or indicators that you're looking at. Two ways to get your questions to us. Shoot us an email at thefinalbar@StockCharts.com or tag us in on Twitter at FinalBarSCTV. We're going to do a mailbag segment a little later in today's show. We'll do another one at the end of the week. So get your questions in. We'd love to address them in one of our future mailbag segments. I want to welcome onto the show for the first time Joe Rabil from Rabil Stock Research. Just met Joe recently, and I've really appreciated his work. He has a wide following in the institutional community. It reminds me a lot of the research that I got when I was at Fidelity, which is hopefully a high compliment for you, Joe. And Joe, welcome to the show.
Yes, it is. Thanks, Dave.
So you started with sort of the multi-time frame look at the S&P 500. Obviously, the S&P pushing again to new highs with apparently no top in sight. Orient us with what you're seeing looking at the charts here.
Yeah, so I thought we only had a few minutes, so I'm a bottom-up guy, but I thought it was worthwhile just to focus on the S&P and give you a little bit of a background on what I'm doing. So starting in the bottom left corner, I've got the monthly chart, and then going counterclockwise, weekly, daily, and then hourly. They all have the exact same indicators on them. I've got an 18 MA and a 40 MA, both simple. And then I use standard MACD, and then I have ADX. So I have the same look in 4 different time frames. And I think the point I was trying to get across here, kind of the key takeaway, is that every time frame has its own price structure and has its own momentum characteristics, as well as its own support and resistance levels. So for me, it makes it easier to see when a down move on one time frame is taking place. It's actually could be an opportunity to buy against the longer term trend. And it just makes it, I started doing this, looking at this grid format years ago, and it has helped me tremendously in seeing kind of the bigger picture and where trends start to align and where opportunities are. The other thing I'd mention is that the monthly chart, looking at that on a regular basis, when I go through, like I say, I go through thousands of charts this way each week. I noticed that the monthly, there are times when, you know, something has been quiet or really dormant for a long time, and then it looks like it's starting to come to life, and it's very easy to recognize when you have a monthly chart up. So like, I give a few examples, like First Solar and Freeport FCX, both stocks that I wouldn't consider timely right now, but they started to pique my interest over the last couple weeks to a month, just based on what they're doing. They've been doing nothing but go sideways for a while, and we're starting to see signs of a momentum improvement on the weekly chart. So it's the type of thing that I would have them on my watch list now, but I wouldn't have noticed those really unless I had the monthly chart up.
It's such a great comment, Joe. And I think the idea of considering these different timeframes is so key, because it's so easy to get caught up into one time frame and forget about how they relate to the others. Your second chart is really focusing on the S&P, the daily view. Where do you see things right now, and where do you see things headed next?
Right. So let's just focus on the ADX at the bottom, and just the simple. So the pattern, like you said in your intro, we've got a pattern of higher highs and higher lows. But if we look at the ADX, so the green line, I'm going to try and simplify this a little bit. The green line represents, it's the plus DI. In directional index, or plus DI is what most people call it, and it's really showing the strength of the buyers. The red line is the minus DI, and that's showing the strength of the sellers. And then the blue line is basically a moving average of the difference of the two. So that's the actual ADX line. And so when you look at the market in this fashion, it just gives a lot of detail. You get a lot more information than I like to look at MACD. It's one of my longest indicators I've ever used, but there are times when it just doesn't tell me a whole lot. And this just gives me a little bit more detail. One of the things that's glaring to me with the ADX, especially with the red DI, and if you start with like right in the middle of June, it peaked. It had a second peak there. And it's crossed down through. I've got a horizontal line at 25. So you can see where it started to make lower highs and lower lows, and it continues to make lower highs and lower lows. And now we're all the way down to single digit land, 7, 8 on the DI, negative DI. What's essentially happened here is, since the middle of June, the sellers have just evaporated. They've kind of just disappeared. And so, I mean, I think that's really kind of the key for me right now, and what I'm watching for. When we get this low on a negative DI like this, you tend to be on the lookout for a reversal, because it's actually at very close to the level that the green DI was at the bottom back in March, which you can see at the beginning of the chart. But so, the only point I'm trying to make here is that, without any type of selling, there's not a lot of volatility, and the likelihood of us making any kind of reversal is really not going to show. So I'd like to at least see some form of that red line starting to make like a higher high, something like that, at least signify that we're going to go through some type of a contraction period or something like that. So I just thought I'd focus on that, because I think the ADX, sometimes it can be complicated, but if we simplify it this way, it can be pretty useful.
That's super, super helpful, Joe. And we only have about 30 seconds left. I did want to, I'd love to just pose you the question. You shared sort of this look at the different trends, looking at some key groups, key stocks. I'd love to know, given what you just said with, the negative DI being so low, the ADX being so high, essentially meaning we're in a pretty good uptrend with no pause at the moment. If you had new money right now, where would you be looking? Where would you be looking opportunistically right now?
Well, I think that the tough thing is it depends on your time frame. I mean, if you're willing to play shorter term time frames, then, I think you want to take advantage in pullbacks in the stronger stocks and a lot in technology and stuff like that. But if you're looking at bigger picture patterns, I think you want to be looking at stuff like the First Solar and for FCX, that type of thing. The interesting thing about this chart is that it shows that the majority of the big cap names, the largest names in the index, are bullish. But if you put this up against the S&P 500, only 50%, approximately 50% are long-term uptrends right now. So it just goes to what we've been talking about. It's a tough environment. It's not, you're really getting the type of confirmation you want to see from a broader standpoint.
Joe, it's been such a pleasure to get to know you better and get to know your work better. Really appreciate you coming on and sharing your thoughts with us. Hope to have you again on soon. All right.
Thanks for having me.
That's Joe Rabil from Rabil Stock Research, and I again, there's a lot of just great nuggets in there that he shared. But what I hope you take away from this is that value of understanding trends and how they operate on different time frames. It's so easy to get the blinders on and focusing on one particular theme, one particular outlook, and not have a good awareness of how it fits into everything else. So some great thoughts in there. Our next segment is the Final Bar Mailbag. As I mentioned earlier, we love to hear from you, answer your questions. We've got a little bit of time, so I'm going to hit on as many as I possibly can in a short period of time here. Question number one, let's see. Since small caps are some 10% below their February high, would you consider the chart to be bullish or bearish or indeterminate? Would you place a trade now or wait for confirmation since we're also at all-time highs on the S&P 500? It's a really good question. And I think when you look at the cap tiers, when you look at large cap versus mid cap versus small cap, there's a lot of thinking to be done in terms of where the leadership is and where you might see the leadership coming from. The challenge that I see with small caps is not the price. The price is actually holding up okay. And if you look at the IWM, which we're looking at here, this is the Russell 2000 ETF, you can see that it's holding up pretty well, continues to make a pattern of higher highs, higher lows, and we're arguably on the next leg higher. This line down here at the bottom is what concerns me. And it's this rolling over in the relative over the last 3 weeks. That's certainly a cause for concern. When I'm looking at equity exposure right now, where I would not probably be leaning into it would be places like mid caps and small caps, because I'm seeing less participation. And I think the breadth tells you more of that story than anything, besides the fact that the relative strength is going down. I think in general, if you want to outperform, if you want to do better than average, then you want to be investing in things that are outperforming the S&P, and small caps are not it at this point. Question number two, I had posted a chart on Twitter about consumer discretionary leading consumer staples, and then it's not just Amazon. I got some questions about what I was actually getting to there. So let me bring up the ratio chart I was digging into. Let's get a second here. Ratios, and we're going to look at consumer discretionary versus staples. Let me just explain, when I keep bringing up this chart, I've referred to it kind of randomly, and I just want to make sure that everyone's clear on it. So we're looking at consumer discretionary versus consumer staples in two different ways. The essence of doing this is to compare offense versus defense, right? Offense, traditionally speaking, would be consumer discretionary, things like retail, luxury goods, hotel, travel, that kind of thing. On the denominator, you have consumer staples, things like beverages, alcohol, stuff that you would, toilet paper, sort of the basic necessity. So, what do people want versus what they need is the very general way of looking at this ratio. And it comes from a long line of ratios that I learned about over time, where people were just trying to measure our equity investors leaning more into the offense or defensive side of the equity exposure. When we're looking at a cap weighted, the problem with that is Amazon on its own is like 25+% of the XLY. Home Depot is another 12 to 13%, which means those two stocks are they're over a third of the index just in those two names alone. So if one of those is having trouble, the whole ratio is going to be affected based on that one stock. So one of the ways you minimize the over impact or the accent of the mega cap names is you look at an equal weighted version, which means instead of weighting these by market cap, which is what the XLY and XLP are doing, you just make an equal weighting. You count them all up one by one. Every stock has an equal weighting. What that does is it weights a little more, relatively speaking, to the mid cap side of those sectors. So this is a better measure of what is the average stock within consumer discretionary doing versus the average stock within consumer staples. And what you can see now, both of these really rotating higher, and the equal weighted version rotating higher as well. And I think that represents more of a broader exposure into consumer discretionary versus consumer staples. I hope that answers your question. That's why I'm looking at that ratio. All right, our next question. Looking at gold, can ascending and descending triangles be only 2 weeks old? And the question you asked was about the GLD, which is this one right here. And I think looking at that, I've shared this chart in a number of different ways. And I think your question is, does this qualify as an ascending or a descending triangle? So, technically, if you look at this book, if you look at the books, you could call this a descending triangle, because it's a horizontal, it's a flat support level, a consistent support level, and a series of lower highs. So essentially, that means consistent support, lower highs. All else being equal, that tends to resolve to the downside. An ascending triangle would tend to resolve to the upside. But again, it's all about how the price breaks out of that pattern. But your question was more about the time framing of it. To be honest with you, patterns like head and shoulders patterns, triangle patterns, they're really meant to be multi-month, much larger things, which is why I've not usually called this any sort of triangle pattern. However, I find that Edwards and McGee, if you read their book, it was really about a more of a disciplined way of applying price patterns. I don't tend to use a lot of discipline with the price patterns. For example, they talk a lot about volume and how volume needs to lighten up through the pattern. I don't pay a ton of attention to volume. So for me, it's more about the trend and the behavior, right? So the fact that this is labeled a triangle or a pennant or a wedge is less important to me because the conclusion tends to be the same. You've had a rally, you've had a consolidation around an equilibrium price, and then we're breaking that pattern one way or the other. So for me, that's the most relevant part of that. But you're right. In general, those tend to be multi-month, much larger term patterns. So you're best not to be calling them a triangle and applying all the techniques you would see in triangle patterns on a shorter time frame like that. Very finally, the last question: when doing relative strength comparisons, why not just use the underlying index or commodity? For example, comparing an asset to SPX instead of SPY, or COMEX gold instead of the GLD. That is a really decent question, and I will tell you, here's my answer. It is a total shortcut, and one of the great benefits of ETFs, and I started in the industry in 2000, I think. What I've seen originally, I remember when ETFs were starting to become more popular, and I remember having discussions with people making the case for how the fact that ETFs were transparent and relatively liquid and traded on an exchange was like looking at a closed-end fund, but it was going to be much more liquid. That meant you had the ability to analyze sectors and asset classes in a much more homogeneous way. Instead of looking at the bond index, the Lehman Ag Index, for example, looking at bond prices, you could actually look at the TLT or the Ag ETF or something like that. And that's something that's very consistent. Most charting platforms all have the GLD and they all have the SPY and they all have the TLT, even though some of them may have better or worse commodity data or fixed income data. So I use ETFs just because I find pretty much everyone can access them. They're relatively liquid. The price data is pretty good. And I find it a better way to make consistent comparisons across asset classes. That's why I use ETFs. You're welcome to use whatever you feel led to do. We need to wrap the show though and go right to the 3 and 3 charts. 3 minutes. Here we go. Chart number 1 is looking at the S&P breadth by cap tiers. And the challenge that I'm seeing, as I mentioned earlier in a lot more detail, is the market going higher and the breadth all rolling over. In general, this tends to be what bull market tops look like. I will continue to assume that the market will go higher until proven otherwise. The trend is positive. Don't get me wrong. I'm not seeing evidence of that not being the case. I'm just seeing evidence of weakness under the hood, which usually coincides with market tops, which is why I'm anxiously looking for some sort of breakdown in price. Chart number 2 is looking at silver, though, taking a quick detour into commodities. We talked about sort of that consolidation pattern that we saw in the GLD. It's worth noting that the silver prices and the silver ETFs are seeing a very similar pattern, but it's actually more of a coil pattern, more of a pennant pattern, which is a rally and then a narrowing of the range. So you have lower highs, higher lows, usually comes to a head, and it's rotated now back to the upside. Interesting to note, a bit of a distribution day today, with the silver actually closing lower, just below the close from yesterday. But overall, this pattern suggests higher highs from here for silver, and gold, similar conclusion. Going back to breadth, the other comment I would make related to the weakening of the breadth and form of the advanced decline lines is the McClellan oscillator. As long as it remains above 0, that tells you weighting the accumulation distribution lines confirms weaker rather than stronger if you look at the average stock. Folks, that's our show out there. We're out of time. I want to thank Joe Rabil from Rabil Stock Research for joining us today. I really appreciate his sharing his opinion with us. For StockCharts.com in Redmond, Washington, I'm Dave Keller. Be safe. Have a great night.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.